When we consider this buyback program, the larger one announced by the Treasury just 2 weeks after its initial quarterly refunding announcement, obviously trying tactically to rein in long-end deals. Is it a coincidence in your mind that that was announced on the same day our national debt crossed $40 trillion?
I don't know if markets respond to exact thresholds like that, but certainly big picture, we have an enormous amount of capital being drained by the government at the same time that businesses have an enormous demand for capital for the AI build out. And something has to give. And what's giving is higher interest rates, cutting capital to every other sector of the economy today.
Well, so when we consider what can be done to bring those interest rates down, perhaps the Treasury's move today was able to accomplish that, at least in the short term. But can it go that far in addressing the longer term challenge, specifically surrounding deficit spending? What's the actual solution, the cure to the illness?
Yeah, I mean, there's two solutions. You can cut spending, or you can raise taxes, or you could do some combination of the two of those. What the Treasury did today, helped a little bit, but you also put upward pressure on short rates. You're also shortening the duration of our debt, which is a risky thing to do. It makes it harder if we see interest rate increases in the future. And it still leaves rates very high, just not quite as high as they closed the day at yesterday.
If we see higher interest rates in the future, do you expect that is in the near term future when we consider a Fed that in its minutes today signaled a lot of officials concerned about sticky inflation?
Yeah, I mean, there's two things pushing up inflation. One is the pushing up interest rates. One is expected inflation. Now, the good news here is the market seems to believe, and I agree with the market, that the Fed is going to keep inflation under control, but they're going to keep it under control by raising interest rates. And second is just the general upward pressure that comes every time there's a voracious demand for capital. And that's what we have right now. And I just don't think any of those are going to change, short of a recession or a bubble bursting or some bad event like that. Higher interest rates, to me, are likely here to stay.
Well, a bubble bursting is something that continually resurfaces in the market narrative around all of this CapEx and the build out of AI infrastructure, and whether or not it's being overdone, whether we're seeing echoes of just a few decades ago. And I wonder if you fall into that camp, Jason, if we are perhaps overdoing it, and what kind of economic risks ultimately could come with that.
To me, there's two broad questions. One is, does AI contribute meaningfully to productivity? There, I'm quite bullish and optimistic. I think we're barely scratching the surface of what the current capabilities are in our businesses, and those capabilities themselves are advancing. But then there's a second question, which is, can you monetize it? And in some ways, the better the AI is, the harder it might be to monetize, because you don't need to use the most cutting edge model for most purposes. You can use a 6-month-old model, maybe with open weights, maybe something from China, and that's going to be putting a lot of price pressure. And we see both OpenAI and Anthropic have been under enormous pressure in their pricing, in their features, and their availability. So will AI work? Yes. Will it work out for the leading companies? I'm less sure.
Well, that's the question everyone wants the answer to. When you talked about the long-term productivity gains and being bullish on them, what is the time horizon you are considering here on those potential productivity effects? Is that a longer-term issue, and where do inflationary effects fall off in tandem with that?
Right. I mean, the problem for inflation is you get the demand first in anticipation of the productivity growth. That's what we're seeing right now with the market up a lot, that fueling consumption, it fueling investment in the sector, et cetera. So this is not deflationary. It's actually inflationary, what we're going through on AI. And I think that it's overly optimistic to think it's going to give us any relief on the inflation side. In terms of when the productivity growth is going to show up, you're seeing some evidence for it in the micro data. I think it might be adding 1 or 2 tenths to productivity growth annually in the macro data. I wouldn't be surprised, though, if in a 1 to 3 year time frame, businesses do a better job of figuring it out, deploying it, and we start really seeing it in the aggregate data.
Of course, there's a whole task force at the Fed that has been charged by the new chair, Kevin Warsh, with looking at things like artificial intelligence and assessing its economic impact. There's also a task force that's looking closely at the Fed's balance sheet. And to return to where we started this conversation, Jason, how should we consider the potential changes Warsh is looking at when it comes to the Fed's own holdings of debt, especially the short-dated stuff, relative to what the Treasury has done today and could look to do in the future? Do these two things exacerbate each other? Can they work together?
Yeah, I mean, that's one of the ironies is you've had a lot of criticism of, the Fed buying long-dated debt, both from the Treasury Secretary and previously from Kevin Warsh, and now the Treasury just went ahead and did that today. The way you'd reconcile those is say that fiscal policy makers should get to decide the maturity structure of the debt, and then the Fed can only implement that. And maybe that's what will end up coming out of this. I think we're going to discover, though, there's a lot of reasons the balance sheet got as large as it did. It's not working that badly. And if it ain't broke, don't fix it.
But something has to be broken here, right, Jason, if the debt is north of $40 trillion. And I wonder ultimately where you cast. Yeah,
but there's no Fed task force that can cut government spending or raise revenue. That's what needs to happen.
Right. This is the wall between fiscal and monetary policy.
Yeah,
Sorry,
continue. The problem is with Congress and the president. They need to fix it. The Fed can only clean up the mess.
Well, do you see that fix on the horizon? Is there any responsible party in Washington when it comes to the U.S. fiscal situation?
I don't see that fix on the horizon. But, one can hope. For example, Social Security has 6 more years before the trust fund is exhausted for retirement benefits. Maybe that will put some pressure on Congress. I'd much rather see that as a forcing event than an even bigger run up in interest rates than we've already seen.